Today's topic is do not do a 2-1 rate buy down until you fully understand what it is. I see a lot of fluff being pitched as a way to get folks to buy homes in this high rate market, but very few details on the pros and cons. So we're going to get into details. That's what we do here. So let's get into it. Welcome back to House Rich, the first time homebuyer show where we help millennials figure out where do I get started in real estate and how to build generational wealth. First things first, why have you never heard of a 2-to-1 interest rate buy down until the last couple of months, right? It's because interest rates are higher than they've been the last couple of years. So there's really no reason to pitch any type of loan program like this the previous 2 years because rates were already in the low threes, high twos, so it really made no sense to buy down the rate. But I think I want to step back with you guys first. Let's figure out, like, when I did the air quotes for high interest rates for a purpose, right? Because I want to step back and let's look at where rates have been historically. Because a lot of folks are just focused on rates the last 2 years where they were in the very high twos or the low threes. But historically, if we pan out and look at this chart, we can really focus on the last 10 years. Like somewhere between a 4 and a 5 is really a good interest rate the last couple of years. So I want to preface this whole conversation with like what a good interest rate realistically is. It's probably something like in the 4s, most likely in the future. All the way through 2023, like Fannie Mae's predicting that rates probably will stay into the 6% threshold. And that's kind of what the guidance is from the Federal Reserve as well, because they help dictate mortgage rates by raising the cost to borrow money, even though they don't directly impact those mortgage rates. So now that we've kind of focused on that, let's talk about the 2-1 rate buy down from that perspective. How it works is the first year, your interest rate goes down 2%. The second year, your interest rate goes down 1%. Year 3, your interest rate goes to whatever the market rate is, right? And so let's say the market rate right now is 6.5%. Year 1, 4.5%. Year 2, 5.5%. Year 3, it goes to 6.5%, right? And so a lot of things I hear with this pitch is, don't worry, year 3, you can just refinance to a lower rate if that 6.5% is too high for you. Horrible advice for a bunch of reasons. The first one is no one can predict the future. Rates probably will be lower than 6.5% 2 years from now because rates are artificially high due to the Federal Reserve increasing them to combat inflation. But who knows, right? And then 2, like, it's not free to refinance, right? You got to pay a couple $1,000s typically to refinance. Having said all that, like, I think rates will be probably somewhere in the, I'm not going to guess, but I think they'll definitely be lower than 6.5% 2 years from now. I'll just say that. I don't like to speculate on this program, but they are artificially high right now. But here's the thing. If the mortgage payment at 6.5% does not fit your budget, don't assume you can refinance in the future. Like, that's the biggest advice I can give to you is that who knows what's going to happen 3 years from now, right? And so, and if you're curious, the lender qualifies you at the 6.5% interest rate for your debt to income ratio. So it's not like your mortgage payment is going to be less the first year, so they're going to be using that towards your DTI. So the mechanics, the mortgage payment doesn't actually change, but there's money put into a kitty to basically pay for the reduction in rate, or an escrow account for the reduction in rate the first and second year. So let's say, for instance, your mortgage payment is like dropping your interest rate 2% decreases your mortgage payment by $300 a month. That's going to be $3,600 a year. So $3,600 a year goes into an escrow account for year 1. And then if it drops at $150 the second year, when it goes down just 1%, $1,800 goes in that same kitty as well. So we have $5,400 in that kitty. And so that money is used to pay the difference between your mortgage payments. So let's say your mortgage, these are completely made up numbers, right? So don't, the calculations say this or that, right? So let's say your normal mortgage payment would be $2,100. And now in the first year, it's $1,800 due to the reduced rate. You pay $1,800, $300 comes from that kitty to go towards your monthly payment. And so that's kind of how that works. It's not free. So really the only reason you should do this is if your seller or builder is actually going to buy down the rate for you. Just doing it yourself doesn't really make any sense because you're not saving anything. The whole goal of it is to have the seller or builder pay for it in this market where the market is kind of shifting right now. So you can see previous videos on how I would negotiate this deal if I were a buyer right now? Actually, forget that. Here's a quick example. So let's say that you were offering, this list price was $400,000 on a home, right? And you can look at this rate chart right here as well to see what it costs to potentially buy down a rate on a $400,000 home. This is just one example, not necessarily your realtor's or your lender's rate chart, excuse me. Let's say their list price was $400,000 and you're like, hey, I wanted to offer $390,000, right? Because I think it's a buyer's market, even though it's really still a seller's market. And so that $10,000 reduction in sales price actually only changes your mortgage payment by about $60 or $720 a month. And so that is something you can do. But in my perspective, this is what I would do. I would maybe ask them to lower it $5,000 and then ask me to give me a seller credit of maybe like $4,000 to use towards buying down that rate, like a 2-1 interest rate buy down. And whatever change is left over, use that towards, cover my closing costs as well. That's what I would personally do. Or the other option is that if you think you're really going to be holding the property long term, it's just buy down the rate like permanently, right? So you can look at the rate chart. It costs about $4,000 in this scenario to buy down the rate a whole percent. You could also just buy down the rate permanently as well. To figure out if it makes sense to just buy down the rate permanently, what you want to do is figure out what the difference in monthly payment is and divide it by the cost to buy down the rate, and that'll tell you how many months it'll take you to break even on buying down the rate. That's a quick method to do. I have a previous video or a previous episode on a more detailed explanation of that evolution. But yeah, that's a 2-1 rate buy down. There are different buy downs. There's a 3-2-1 buy down, and so that's a rate buy down explained. If anything was not clear in this video, just leave a comment down below and I will break it down a little bit more for you. So see ya next week. And buy land. Rumor has it they're not making any more. Thanks. Thank you for listening to the show. If you want to connect with other listeners and also dive deeper into topics, as well as attend live trainings every Tuesday at 8 p.m., click the link down below and join the First Time Homebuyer School. See you inside.